All right, let's dive in. The investment world of 2026 is, well, it's a total paradox. So today we are going to break down exactly what is happening, why it's happening, and most importantly, what it all means for how you think about your money.
So here it is, the big question, the central puzzle we have to solve. You've got the US economy and its stock market just defying gravity, right? All powered up by this massive AI boom. But then you look at the rest of the world and most other big economies are just struggling to get out of first gear. It's a real head scratcher and it is completely rewriting the rules for investors everywhere.
So first things first, we've got to wrap our heads around this idea of a great economic divergence. You know, the old saying, a rising tide lifts all boats? Well, you can forget about that. We are now living in a two-speed world where different parts of the globe are on completely different paths. Understanding this split is absolutely step one to figuring out 2026.
And the difference is it's stark. I mean, look at the numbers. The US is projected to grow at a really solid 2.3%, thanks to all that money pouring into AI. Meanwhile, you hop over to Eurozone, and they're looking at a sluggish 1.2%. Their main industrial engine, Germany, is basically sputtering. This gap is huge, and it's telling global money exactly where to go. And this split isn't just a developed world thing. You see it in emerging markets, too. They're not one big group anymore. On one side, you have India, which everyone is pointing to as the new growth engine. And for good reason, the fundamentals are strong. Then on the other side, you've got China, which is going through this really painful shift away from its old property-fueled model, and that's acting like a massive anchor on its economy.
So the big question is, why now? What is actually causing this global economic fracture? Well, it turns out two fundamental rules of the entire investment game have changed. And believe me, if you don't understand these new rules, you are basically flying blind.
Okay, so the first new rule is really simple, but its impact is massive. The era of free money is over. It's done. We have entered a totally new world, and you have to understand the mechanics behind it. Okay, I love this analogy. Think of an economy like a car engine. The neutral interest rate, what economists call R star, is basically the engine's idle speed. It's the rate that isn't hitting the gas, but it isn't slamming on the brakes either. For years, that idle speed was super low, like around 2.5%. Now, most analysts think it's reset to a much higher 3.5%, and that, my friends, is a tectonic shift.
And here is the million-dollar takeaway from that. If the central bank's key interest rate is at 3.5%, their policy isn't tight, it's neutral. It's just idling. This explains why the economy hasn't just crashed and burned despite all the rate hikes. And it means anyone sitting around waiting for the central banks to slash rates back to zero to save the market, well, you're going to be waiting a very long time. Now, this new reality of higher rates makes current stock market prices look kind of terrifying. This chart shows something called the CAPE ratio. It's a way to measure long-term stock valuation. As you can see, the historical average is about 17. Today, we're pushing 40. The only time it was higher was at the absolute tippy top of the dot-com bubble. This means the market is priced for absolute perfection, which is, let's just say, a very risky setup.
Okay, so let's recap. We've got a divided world, totally new rules for interest rates, and stock valuations in the US that are sky high. So that brings us to the most important practical question of all. How on earth do you even begin to build a portfolio in an environment like this?
So, what's the playbook for 2026? Well, there's this really fascinating debate happening, and it pretty much boils down to two main philosophies. You either play ironclad defense, or you launch a surgical offensive strike. This quote from BlackRock just nails the aggressive, pro-risk side of the argument. What they're saying is that these huge megaforces, like AI, are so powerful they make the old models of diversification totally obsolete. In this new world, you have to lean into the change, not try to hide from it.
But when you really dig into all the analysis, the strategy that seems to make the most sense is this: a barbell approach. So picture a barbell. On one side, you have your ironclad defense. That's your high-quality bonds, your gold, your real assets, rock solid. Then, on the other side, you have your surgical strikes. These are very selective, actively managed bets on unstoppable themes like AI and in markets with strong fundamentals, like India. It's all about balancing that deep safety with targeted, high-growth potential.
So, the barbell strategy sounds pretty smart, right? A good way to balance risk and reward. But no strategy is ever foolproof. Every single playbook has a weakness, a blind spot, that could potentially derail the whole thing. So what are the hidden dangers we really need to be watching out for?
And that brings us to our final and maybe most important section, the hidden risks. Being aware of those low probability but super high impact events, the things they call black swans, is just as critical as your main strategy. So let's look at the 3 biggest ones on the radar for 2026.
Okay, here they are. First up, geopolitics. Some conflict escalates, oil shoots past $100 a barrel, and that whole inflation is dead story goes right out the window. Second, the no landing scenario. The economy actually overheats, inflation comes roaring back, and the Fed has to start hiking rates all over again. And third, the big one, the AI bubble bursts. What if companies can't actually show a real return on all this investment? The story could break, and that could trigger a very fast 20 to 30% correction in the market.
So as we wrap up our look at 2026, the final question really comes back to you. We're in a new game. It's got new rules. It's a world of huge differences, high prices, and some really serious hidden risks. Understanding all of this is step 1. The next step is deciding how you're going to play it. Are you going to be the defender, the attacker, or the strategist who finds a way to balance both?